Hey guys, thank you for joining us. I'm Barry Page, and this is Legacy Money, the show that shares the truth about money and how it works so you can live more, give more, and leave more. Today, I'm joined by my co-host, John Webster, who's starting to be a regular around here. John, say hello.
Hello, everybody. Welcome.
Great to have you with us. Today, our topic is banking, and specifically infinite banking, and how you can use the process to eliminate debt and take control of your finances. So thank you so much for joining us today. We're going to dive right into things and talk about banking and the process of how it works. Now, this is relative today in our current environment. Perhaps you've heard the news that Joe Biden has chosen Janet Yellen to be his treasury pick, meaning that she will oversee the IRS and the treasury and basically how the money is collected and doled out. Now, some of you might know that Janet Yellen is a former head of the Federal Reserve. And this is something that, it concerns me greatly if this comes to fruition, but she will hold the purse strings. The Fed has insane amounts of powers, but now she's on the other side, on the government side. So the Federal Reserve isn't necessarily a government institution. It is a private cartel, for lack of a better term, of banks. And so now Janet Yellen, who used to head the Federal Reserve, will now be in control of the IRS and the Treasury. So she can make decisions about where the money is spent. And so you can see from these headlines that she'll have a lengthy to-do list on taxes from day one. So you can kiss your tax breaks goodbye, it looks like. And I'll put up some other older headlines where Janet Yellen says labor and inflation complicate the Fed's plans. Well, isn't that something? And more recently, she did a speech, after the last financial crisis and what we can learn from that. So who knows what the future holds, but that's really what we wanted to discuss today, is how you can take control and get your money out of the control of the government and the big banks. So banking is a process, and that's really as simple as it gets. Is just understanding that the banking process is something that you can take control of. And we're going to be speaking pretty much directly from our favorite book, Becoming Your Own Banker, Unlocking the Infinite Banking Concept, which is the best-selling book from R. Nelson Nash, and just share with you a little bit about what we learned working with Nelson and how you can also practice infinite banking in your life to take control of this process. So I always like to start out when I'm talking about banking with a quote from Henry Ford, of course, who lived many years ago, but he was living when the Federal Reserve and the IRS were created in 1913. So this is what Henry Ford had to say. It is well enough that people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning. Well, folks, we're here, and the banking and monetary system has been flooding.
It hasn't gotten better, has it? It's gotten a lot worse.
Yes, it's gotten worse, and it's probably only going to get worse. So let's take a look at the problem, John, that people have. So this is right out of Nelson's book. Why don't you talk a little bit about what Nelson is saying in this chart here?
You know, what he's saying is that in the flow of money that most people have that comes into their lives, a large percentage of the flow of money goes right out the other door to service things like automobiles, housing, living expenses. And if they're in the very small percentage of individuals in our country right now, they're trying to put a little bit of something away towards savings. Now, right now, you don't see a red bar next to savings because overall savings interest rates are almost negligible. They're almost non-existent. But a chunk of money in the red bar is flowing away to service interest in all of those aspects of life: automotive, loans serviced with interest, housing serviced with interest, living expenses, that flow of money serviced with interest. And you see a very, very big factor is where some people mistakenly believe that their biggest invested asset is in their housing. Large flow of interest goes away with an amortization schedule to the bankers downtown.
Exactly. And, so most of the people have been fooled into believing that these 2, 3, 4% mortgage interest rates that we pay today, we're getting a good deal on interest, and we are. But the flip side of that, it stays in control of the bank. So here's really the problem with all of that, that all of these are financed with other banking institutions. And that means that the interest portion of every dollar that we spend is perpetual into infinity, right? So you'll never get the money back. It'll never grow for you again because it's gone. So really the volume of interest is the issue. It's not the annual percentage rate. So even though you might have a 3% rate on your mortgage, you probably also understand that there's closing costs, there's fees, all of these things charged up front, and the interest is primarily charged in the beginning. So if you just take a look at a loan amortization schedule after the first year, the second year, third through the fifth year, you're going to see that the greatest proportion of that money went to interest, not to principal. So back looking at this chart here, the red line, right? And since the average American family moves about every 6 years on average, they basically foot the entire bill for that cost. So they paid very little in principal reduction. Most of that money has gone towards interest and fees. And, I already hear people, maybe thinking to themselves, well, I pay cash or whatnot, and we'll get to that later. But just understand that the volume of interest is the issue. So if you've got a bank loan, an auto loan, a credit card, all of these things add up. Now, maybe the reason that you're joining us today is you're fed up with banks. You're sick and tired of paying interest and fees to the banks while they gamble with the money, and you want to protect and grow your wealth. And you're concerned about your money, and rightly so, especially in the light of some of the recent news, which I highlighted a little earlier. So, John, what's the question that we like to ask people?
Well, the question is if you thought what you thought about money, if what you thought to be true about money turned out to not be true, when would you want to know about that? If half of what you believed were not correct, would you want to know what the truth really is? And, a lot of people are going down the road. They believe that there's truth, but I tell people all the time that the truth about money is it's kind of shocking and scary. We've had all this talk recently in the news about slavery and reparation, and we got rid of slavery back with Abraham Lincoln, right, in the late 1800s.
Right.
At least we thought we did. But then about 1913 comes Federal Reserve and the IRS. They were formed 1913, both of them, ironically. And what most people don't realize today is that they're on a path of voluntary, what I call servitude, serfdom, right? And they're giving 40 hours a week or mostly more to bring home money to serve the master over their slavery. Their voluntary enslavement is being served to that big tower downtown called the bank, right?
Right.
And it's not much of a different working relationship than when slaves were there with their masters. They were provided 3 meals a day and they didn't get a whole lot of extra money to spend at the end of the deal, right? And
Right.
here today, many people have signed up for the process of voluntary servitude.
Sad. It's sad. So what we'd like to do is just talk to you about how you can take control of this banking aspect in your life. Now, this is a quote right out of Nelson's book, but Nelson said, learning to control it is the most profitable thing that you can do over a lifetime.
Mm-hmm.
So that word profit, people like to earn profits, but unfortunately, most people are working for a paycheck. So they're not earning profits. And what they think of as profits is maybe the return on their investment, which many times they're in the dark. And as you see here, there's some government institutions and the Fed, the banks, and the percentage rates, and we get all caught up in that, this rate of return. And when you really think about it, who's in control of your money? Is your money in a IRS qualified plan, an IRA, a 401k, a 403b, 457, even a Roth is an IRS plan?
I like to call those government partnership plans.
Government partnership. So the government makes the rules. And I just showed you who may be in control of those rules here real soon. And of course, people think the Congress and this and that. Yes, the Congress has to vote on these things. But, once we have somebody at the helm there that basically is in bed, with the Fed, then who knows what's going to happen. But I want to, just kind of touch on, something that I beat the drum on a lot, but I'm sure many of you, if not all of you, have heard this. It's standard advice. We've been told save money. It's actually turned to invest money now. We should invest in our 401k. We've been told to get out of debt. Most people aren't doing that. We're told to invest for the long term. Don't worry, the market will come back. Like they told us in 2008, 2009. Of course, it has come back, right? But what if you were retiring in 2009, 2010, 2011? What happens if you're retiring in a down market? So that's why, I stress to people the old adage of buy low, sell high. Right now, the markets are at an all-time high. So it might be a good time to take some money off the table if you are investing in the markets. But invest for the long term, we've heard, and diversify. So most people's idea of diversification is they own a mutual fund that's inside of their 401k. So again, it's controlled by the government who makes the rules for the 401k or IRA, and it's being held by the banking institutions inside of a mutual fund that they own, control, and earn profits on. So I'm not sure how well that's working, but investors who have followed this advice have lost tens of trillions of dollars, and they'll never get that money back, not for themselves, not for their family. That money's gone forever. And many that lost their retirement savings have had to return to work. So when you see these older people working at Walmart and McDonald's, they don't necessarily want to be there. They've had to go back to work just to survive because they've lost their money. So once you retire, and you lose money, it's much, much different than when you lose money in your working years. And so I always ask, if that works so well, why do so many people struggle today when we live in the most free and prosperous country in the world, at least for the time being, anyway? So we're living in this great country. We are free to do what we want, but people are still struggling. So, John, this is what did Nelson have to say about banking?
Well, Nelson always said that banking is the most important business in the world. And he wanted to teach people how to take control of the banking function in their life. It's all about where do you store your money and how do you store your money, right?
Yeah, it's a process. And so on the screen here, and I'll let John explain this, but this is a copyrighted, trademarked process diagram from Nelson Nash's book. It's on page 26 of Becoming Your Own Banker. Okay, so why don't you talk a little bit about that process, John?
Well, the process is first capitalizing the infinite banking process through premiums. That creates a money pool. That money pool is going to maintain and continue compounding over a lifetime, producing dividends which are given to the policy owner in the policy tax-free as tax-free growth. They then, from that location, the policy owner has the capability of putting that money pool to work into secondary investment operations. The policy owner has first rights to do whatever they want with that cash pool, that cash value. The other powerful thing about the IBC process is that every dollar that's accumulated in that policy is growing tax-free, is accessible, non-age restricted tax-free through a lifetime, is passable tax-free, but it's not just passable tax-free. It passes with a significant multiplied exponential multiplier in tax-free death benefit. So you may put, several $100,000 into that money pool, that IBC process, storing up banking function over life, and it may pass on $1 million. You put in a couple $100,000, it passes on $1 million tax-free to your beneficiaries. That's because the storage vehicle that Nelson taught to use was to engineer and specially design a whole life insurance contract as the vehicle to store up money.
Right. So as policy owners with a mutual company, we share in this process with other policy owners. Mm-hmm. And so basically you can think of it as a business that you own and control, and you do have partners, but who better would you want to be in business with than other like-minded individuals who love their family and understand this process the same way that you do? Mm-hmm. So I do want to point out a couple things that in this process diagram here, that this money pool that we all share in does have expenses, and that's to run the insurance company, the expenses of operation, just like any business, right? Yep. And we all share in that. And then, of course, since what we're talking about here is life insurance, participating life insurance, people die. Now, that isn't often, but, people die every year, of course. And so we spread the risk with different companies and carriers. We're independent agents, but each company has their own expenses and they have their own death claims. And so that comes from the same money pool that is growing over time. Yep. And, the way Nelson used to explain it in his seminars is kind of like water all over the earth, right? There's really just one body of water, this great giant ocean. and it flows through rivers and streams and lakes and
Goes up in the
precipitation.
air.
Right. And that's all under God's control. And Nelson would always say, you know, those are God's laws, right? And so what we're dealing with here is, you know, man's laws when we talk about banking. But what we want to illustrate is that you can be in control of this banking process. And these insurance companies use this same pool of capital in a very conservative way. They make loans, as you see here, to policy owners. We're number one in the equation, but they also make mortgage loans, and they're not your typical residential loans that we think about. They're typically business loans for great expansions. Many large cities were built by life insurance companies, and they make loans and they repay the loans. And then there's, of course, joint ventures with, you know, believe it or not, banks. Banks are one of the biggest owners of policies, and we'll talk about that a little more in a minute. But so all of this was conceived from Nelson in the book, Becoming Your Own Banker. And this book was first published in 2000, and we're currently, the 5th edition just had some updates to deal with things that changed over the years, like interest rates, inflation, and whatnot. But the book serves as an educational course. Nelson always said that it is instruction about the power of dividend-paying, participating whole life insurance. And it's just like you would take a class in college or even in high school or maybe graduate school, I would call this. You can basically get your MBA, your PhD in personal banking, right?
Yep.
I'm not talking about banking with your local banker, which, you know, we all do, but a way that you can control that process using the vehicle or the tool of participating whole life insurance. So what the book really does is demonstrates that our need for finance during our lifetime is just as important as your need for protection. And so most people think of life insurance just for protection, and it does a fine job at that. But this is an extra way to get another use of your money and certainly finance as many things as you want. So when we solve for that need for finance, we wind up with more life insurance protection than most companies would ever issue on us, right?
Yep.
And then when it really becomes important is when we're most likely to need it. See, the problem with most life insurance policies is that they run out right when you need them the most. So most people understand that you can borrow from or against the cash value of a whole life insurance policy, but most people really have limited availability because they're trying to buy cheap life insurance, right? So even if they bought a permanent type policy, it wasn't constructed right. So and they were buying on that scarcity mindset. But Nelson always used to ask, and I'm sure you remember this, John, is he said, have you ever heard of anybody having too much money in the bank?
No.
No, they don't. So why don't you read a little bit about what Nelson said?
So the whole idea of a banking policy is to recapture the interest that one person is paying to the banks or the finance companies for major items that we're going to need or want during our lifetime, such as automobiles, major appliances, education costs for our kids, homes, investment opportunities, business equipment, even business capitalization. So I've had clients that have actually accumulated enough in their banking policies that they've purchased businesses with that capital and bought another source of revenue, right?
Fantastic. So they've basically taken one asset and multiplied the profits, right?
Yep.
because we can recapture the interest and then we can utilize the asset to create more profits.
Yep.
So, actuaries design whole life insurance just like engineers design and build machines. They work with mortality tables. And that's why it's so predictable, is because they're looking at 1 million lives over an entire lifespan, over the period of 100 years, right?
Yep.
And so these lives are selected and using their statistics. So they have to be underwritten.
Yep.
Just like a loan would have to be underwritten, these actuaries underwrite the policyholder. So this data is then used to calculate dividends based on the company's current mortality experience. So every year they're looking at, okay, what were our expenses back to this process here, right? They're looking at what are our expenses of operation this year? What do we have any death claims, right? So they adjust that every year, and then they'll base that year's dividend on those expenses. Now, the dividends are not guaranteed, but these companies, these actuaries, these engineers, all right, they have quite a bit of experience. And since they're looking at 1 million to 10 million lives, they're pretty good at predicting this stuff, right?
Yeah.
So that's why the companies we deal with have all paid a dividend every single year for 100 years or more.
Yeah.
And that's the way most mutual companies are. And there's only a handful of mutual companies that actually use this process. Most of the companies are stock companies. So there's only a handful of them. And then out of that handful of mutual companies, there's even less that can be utilized with IBC. So these dividends have actually also increased over the years because of longevity. People are living longer. As a matter of fact, just in the last few years, they've changed the whole mortality tables, right? So if you look at children today, instead of the age 100 they used to use, they're looking on out to age 120 and beyond.
Yep.
So, John, what about this principle that Nelson talked about?
Nelson said the very first principle that must be understood, and many people miss this, is that you finance everything you buy. And I often have people that say, no, I pay cash for everything. And I go, no, you finance everything you buy. You either pay interest to someone else, or you give up the interest that you could have earned on the money that you spent when you spend cash. And that is truly a financing cost. You eliminate those dollars from your control, and those dollars are never going to work for you, never going to perform, and never going to give you a profit again. And that's a financing cost. So you finance everything you buy.
That's good. They're gone. So yeah, that one, it took me a while to get my arms around that as well. And most people that pay cash don't quite get it initially. But once we understand that our money should be working for us, our capital has a cost, right?
Yep.
So if it's in a shoebox, if it's in the bank, if it's invested with a financial institution, if it's in a business, wherever it is, again, our goal is to have that money earning a return, a profit. So Nelson, that's infinite wisdom there. And I wanted to read a quote from another colleague of ours, and then I'll let you maybe talk a little bit about lost opportunity cost. But before any capital outlay, before you spend any money, you should first consider the cost, and not just the cost, but the opportunity cost as well. Yep. Remember, it's not just what you pay for, but how you pay for it. And that's from Don Blanton, who is the creator of Money Tracks and software that I often use. But that lost opportunity, if can you kind of maybe look at that with numbers here, John, and just explain to people what's going on?
So if you've got an expense that you're going to pay of of $10,000, but that money could be growing at 5.25%. And that money could be growing for the next 30 years until you reach, say, retirement at 5.25% rate of return. Then spending that $10,000 to go buy a car, depreciable asset, may not be the wisest thing, because that car of $10,000, that money would have earned $38,142 in addition to the original purchase. This is opportunity cost that is lost. That's a financing cost. That is a cost of the performance of your money that is evaporated and never to be controlled again. And that's where with IBC, we want to harness the power of uninterrupted, ongoing compounding growth on your money before you take and utilize it in any other secondary financing or investment opportunity.
And so that's what Nelson was talking about when he says we finance everything we buy. So if we've got $10,000 cash and we spend it, that's what we're doing, is we're giving up that ability to earn interest on the money, which in this case would have been $38,000 over the 38 years, plus the initial expense of $10,000.
Yep.
And again, it just keeps going, though. It's perpetual from there. So
Yep.
Your family will never see that either. And like you said, if it is something like a car, that's a depreciating asset, right?
Yep.
So you're losing money on that. Now, had it been a business maybe, or something that was going to increase in value, it might look a little different. It would actually be compounded even more. But let's take a look. Really, there's three ways to make purchases. And again, this is from Don Blanton, and he had a great way of illustrating things. And so basically, we can save money, be a saver, we can be a debtor, or we can be a wealth creator. So let me just kind of walk you through those. And many of you may have seen this before. I use this in pretty much any time I'm talking to a client, but I think it's worth revisiting just to help people get their arms around it, because it sometimes is hard to understand. So if this black line, right, if this means ground zero, let's think of the ground zero, right? So we're here. And if we want to buy a car, we can borrow money, right? We can just go out to the bank if we've got credit. Again, you got to qualify for the loan. People don't often take that into account. But you got to fill out paperwork. You got to, give some blood, maybe. Who knows what they might ask for these days. And in reality, we do give blood. When you apply for life insurance, you will have to give a little blood. The good thing is you don't have to do it anymore once you are approved and once you qualify. But with a bank loan, you got to do that every time. You got to go back to the bank. You got to fill out, as Nelson called it, Mickey Mouse paperwork. You got to see if they're going to give you a credit score of this or that, and you got to qualify for the loan. So this red line, you see, we borrowed the money. Then the bank's going to set up an amortization schedule, and we'll have to pay it back according to that schedule that they have set. And if you don't repay the loan, guess what? They're going to take your car, right? Or whatever you borrowed money from. So we'll pay it back over time. So as you see these steps, and now, the first time, maybe it's 5 years, we're back to ground zero, right? So now people say, well, I'm going to start saving money now, right? Well, what happens about the time that you get that car paid off? Well, you got to buy another one, or you want another one. You might not necessarily need to buy another one, but the car companies and the finance companies have convinced you that the rates are low now, and man, you can get a rebate on that new car, and the best thing to do is just to get another one. So we borrow money again, and we start the whole process over. We pay back the loan. Here we get back to ground zero. And unfortunately, this is just a vicious cycle, because every time we borrow money, we pay it back. That money is going away from our pool of capital. We have no control over it. The bank does. The bank can take the asset, whatever expense where we've used the money, and it just continues and continues. And most people, we use the car example, or Nelson did in his book, because most people are going to buy, 5 to 10 vehicles over their lifetime, if not more. And so it's easy for people to maybe understand that. So let's talk about the saver now.
Yep.
Now, if you notice this chart, it looks almost the same. It's just inverted, right? So in order to have capital to pay cash, you first got to save money. So that's what the saver does. He saves money every year. And then
makes payments.
He got some money and he goes out and he spends the money on the expense, right? Mm-hmm. So now the money is gone. So while it may have been working here, now he spent the money. So the money is no longer working for the saver, the person that pays cash. Yep. Now, one thing I want you to notice too, is that it took a few years for the person to get to the point where they had the capital to pay cash.
Yep.
Right? So the saver gave up those 4 years or 5 years or 6 years, whatever it is that it took them to save the money. But I don't have to pay interest. Well, maybe you don't pay interest, but what you have given up now is the ability to earn interest on the money. You've spent the asset. So whatever interest may have accrued, whatever savings you had is gone now. And then the process begins again. That same person wants to buy a new car, another, whatever. The expenses always seem to come up, don't they? It doesn't matter how fast you pay off the debt or it's called Parkinson's Law, and it's in the book. Expenses rise to equal income. So there's always something, whether it be a car, a piece of equipment, a new house, we get locked into this process. So the saver, yes, he's saving the interest that he would pay to a financial institution, but he's given up the ability to earn that interest.
Yep.
So let's take a look at what we advocate, and that's to become a wealth creator. So as you see here on the curve, we still had to save money, right? We still had to accumulate a pool of capital. But in this process, what we're talking about is using that capital while it continues to grow, right? So at this point, we can borrow the money just like we would from a financial institution. But in this case, it's from the financial institution that we took out our insurance policy from, right?
Yep.
So we're not actually taking the money out of the asset. We're using it as collateral. Yep. Now, this is very important. If you go to a bank and ask for a loan, what's the first thing they ask you? Well, what do you have as collateral? Now, most people are used to making at least two types of loans. That's a mortgage and a car, an auto loan, right? So in those cases, the automobile and the house serve as the collateral. But if you're going to buy something else, or maybe you just want to take out a signature loan or a HELOC or some other type of loan, there's always collateral. You're going to collateralize that. And so if you don't repay the loan, the bank is going to take whatever asset you used as collateral. Right. In this case, our lives are the collateral. So the bank, in this case, is the financial institution that we own and control as the owners of these policies. So we're taking a loan against that life insurance policy. So if we default on the loan, the bank will ultimately get that money. Now, here's the difference. There is no amortization schedule. You're not going to get a payment book. We don't get a payment book. Clients that use this process don't get a payment book. We have to do this on our own. Now, we help with this process, but the bank, in this case, again, you're controlling the banking function, and the insurance company really doesn't care if you repay the loan. The loan will accrue with interest over time, and if you don't pay the interest at a minimum, which we don't recommend, we recommend that you do repay. You become an honest banker, and you repay the loan just like you would any other financial institution, and that money goes back into that pool of capital, which again is available to you at any time. But if you don't, when you die, that money will be subtracted from the death benefit. And we'll get a little further into that, but just understand that's what allows the policy to continue to grow through the dividends, because you're not actually taking the money. You're borrowing against it. You're using it as collateral. So you're using the capital that you put into your system as collateral. And over time, it gets better. So in the beginning, we do have to, again, save money and repay the loan. But as you can see, over time, it catches up. And so this curve is uninterrupted. You've heard of the compounding. That's what is happening. John alluded to it a little earlier. You have uninterrupted compounding. So that is what it looks like when you compare all three of them together, right? So you just have to determine which would you rather be. There's really only three ways to make any purchase. You can borrow money and be the debtor. You can save money and give up interest, or you can become a wealth creator using the process that we're talking about. So, John, if you don't mind, talk about this solution a little bit.
Well, we got to start thinking like bankers. We want to think differently about how our money works for us. And so velocity is the speed at which the money works. Banks like to loan out the money over and over again, and because that's where they're going to bring back profits to themselves, right?
Absolutely.
And so we want to think like a banker, right?
Yes.
We want to get our bank capitalized. We want to be able to use that money, put it to work, and over and over again, we want to pay back that money, pay back that loan, pay back interest, and put it to work again.
And once we're in control of this process, we can do that, right? So as we capitalize our system over time, as we just showed, this money continues to grow, and it only gets better over time. So we can use this, again, Nelson said, our need for finance is so much greater than anything else. And that's why he called it the most profitable thing that we can do over our lifetime. And so by just using the system, it gets better. We're doing the same thing that the bankers do, right? That's why a bank will offer you a lower interest rate for a shorter amortization schedule. Just think of a mortgage, right? So if a 30-year mortgage is 4% and a 15-year mortgage is 3.75%, well, the bank loves that. That's why they want you to get the 15-year mortgage, because they get the money back quicker, right?
Again.
Which, by the way, came out of thin air. We don't even have to go down that road right now, but banks like loaning money over and over again.
Yep.
So we can do the same thing. Now, everybody always wants to get into the numbers, and Nelson always advised about, when you read this book, don't get so caught up in these numbers, because these numbers are in your control.
Yeah.
He said it's all about how you treat your system.
Your banking.
And so your system, just like if you have a car, and your neighbor bought the exact same car on the same day, chances are one of you is either going to trade that car, or one of you's car is going to wear out before the other one, right?
Yep.
And it's the same with your bank, because you're in control of it. So not everybody's going to treat it the same. Not everybody's going to pay their loan off at the same time, because they're in control of the process. You're not going to have the financial institution knocking on your door saying, hey, we need your payment, right? So you're in control of the process. But what I did want to show, if you'll kind of look at this illustration and kind of explain to people, how this capitalization actually works, John. So what we have here is a life insurance policy illustration designed for IBC. So John, if you don't mind kind of going over that.
So on the left side, you'll see contract premium, and they're showing capitalizing this policy over 5 years with $40,000 per year. In year one, if you look at the the net cash value column, second column from the right, in year one, that policy capitalized about $22,466 of cash value. By year two, you put 40,000 in, and now the cash value has gone up to 58,201. By year three, you've got 96,000 in cash value in the cash value column. You've got the ability to actually utilize that in your lending system anywhere along the way, but we're showing over 5 years, we capitalize $40,000 per year times 5. So we put $200,000 of total build into the foundation of the policy. And in 5 years time, we've got $180,960 of net cash value available in our lending process. Now, there's some that get all worked up and say that the big life insurance companies are mean and they won't give you this death benefit and your cash value when you die. And I just want to point out something. We put in $180,000 of cash value, and that's true. They're not going to give you that $180,000 of cash value on top of the $949,000 of death benefit we started with. But because we put $180,000 of cash value into that policy, the policy's death benefit went up by $485,000. It went from $949,811 up to $1.4 million. 32,000 in total death benefit that the life insurance company will pay your family or your beneficiaries tax-free if you die. Now, I'm just going to ask you a real simple math question, and I hope you get it right. Would you rather have, by putting $200,000 into this thing, at that point in time, would you rather have $949,000 plus $180,000 of cash value paid at your death? Or would you rather have the $1.4 million that the life insurance company is committed to pay tax-free at your death? Which one of those is better? I would take the right column, frankly. Seems like a better equation. If we go down, then we minimized off the capitalization a little bit. We backed off from 40,000 down to 19,340 per year, kind of ongoing. And you'll see that at year 10, we've now got $329,000 of capital in the net cash value column that we can use for banking. We can use it to capitalize business capital. We can use it to replace financing needs in our life. We can use that to buy an investment property that's going to generate a strong positive cash flow and potentially create much higher returns than the tax-free returns we're getting here. But at the same time, our capital here will continue compounding because, as Barry said, we're collateralizing by that $329,000 to take it into secondary investment. Now, let me ask you, if you go out and buy a $200,000 property at year 10, and you use your IBC policy as the collateral capacity, and something happens to you and you die, is your family going to be upset? Yeah. You hope so, right? You hope they're upset that you're gone. But that $200,000 investment property, you had multiple ways you could have chosen to finance and capitalize that. You could have gone to the bank, right? Mm-hmm. And you could have had that $200,000 still available in your savings or your 401k, right? Or your IRA. And you could have gone to the bank and got a mortgage from the banker for that $200,000 investment property. And it would have generated about the same return on that $200,000 cash flow property, right?
Right.
But if something happened to you and you had your money sitting in the IRA 401k in a government partnership plan, now it's going to get taxed when your money passes to your beneficiary potentially. And you don't know what Janet Yellen will do with the tax laws going forward, but I would guess taxes are going up in the future. But because you capitalized it here from your IBC policy, they're going to subtract that $200,000 note that you borrowed from your banking policy from the $1.6 million death benefit that pays out tax-free to your heirs. And your beneficiaries are going to get 1.4 million tax-free. Which of those two equations is better?
Man,
So
I like the idea of the death benefit at that point.
You still have that investment property 100% debt free at this point, because that loan of 200,000 got paid off as a subtraction from the death benefit of the 1.6 million. Right?
Yes. So
better equation.
Yeah, and I'll come back to you here, just kind of add a little bit. I always refer to that. People seem to these days with this Bitcoin and the age of I want it now. People, this whole get rich quick thing. But I think people, older folks that may be over 40, that may have experienced some losses in their lifetime, understand that get rich slow might be a little bit better, plan. Yeah. And get rich slow while you're protected and while your family is protected. So, the mortgages, the other assets, houses, real estate that we might purchase, the banks actually love when you have life insurance. As a matter of fact, many people go out and buy, mortgage insurance, mortgage life, and pay double, triple for it, quadruple sometimes. And they pay that. Again, the bank gets a piece, the insurance company that sold it gets a piece. Why not just put that and have your dollars working harder into one plan, right?
Yep.
And I do want to point out a couple things. He didn't really talk about the dividend, and that's fine. We don't like to focus on the dividend too much, but the dividend is what allows this policy to grow. And so as you see here, there's a guaranteed column.
Yep.
And then there's a non-guaranteed column. Now, this non-guaranteed column is based on the current dividend scale, which we are in the absolute lowest interest rate environment that we've been in my lifetime. And I think since it's been around, that it's possibly going to do. So this dividend over here, these columns that are absolutely guaranteed, assume that there is zero dividend paid. Now, I mentioned earlier that the companies, the carriers that we work with have paid dividends for over 100 years, every single year. Now, try to compare that with any stock company that pays dividends or anything else, and I think you'll find it hard to match. But again, this column assumes that a dividend was never paid from day one. And as you see, the cash value and the death benefit are still growing. And the reason they are is just because of those actuaries and that mortality that we talked about earlier. So there's nothing you can do about it. These policies are guaranteed to get better every year, right? And then when you add the dividend on there, which in this case, if we do look at that year 10, so now you've put in 200 grand and that dividend is over $12,000, right? And as you see, it's been getting better every year. And that's because, again, of this actuarial data, this engineering that the actuaries have done to help it perform based on those, again, after expenses and death claims and all that have been paid. Mm-hmm. So it only gets better. And what I want you to note here is, yes, there's still a base premium. There's many things you could do to adjust that, not pay it or reduce it or take loans or whatever. But what I want you to notice is here that the premium was 19,000 and some change, and the dividend is 12,000 and some change. So, and if you look, the dividend just keeps getting better. So you put in 19, but the actual cash value, look at here, increase in cash value after dividend. Look at that. What does that say, John? How much did it grow?
33,571. I don't know about you, but if there's a pot that you can park $19,340 in, and it's going to give you access to $33,571 this year addition, would you do that?
Doesn't get much better than that, man. I like it. I like it. So let me just kind of show you as you know here, the age here starts to go up. And so I just want to show the next screen. And this policy, the premiums were due until age, the contract premiums anyway, for 35 years, age 73. So talk a little bit about this in the latter years, John. What's actually going on with this policy now?
So the later years, this policy has become what's called fully paid up. It actually can't receive premium. That's why that left column shows zeros. But the policy is guaranteed to stay in force until you die. So from 78 on to 98, it's showing it growing. The net cash value at that point in time at 76 years old, there's $2.499 million, $2.5 million of net cash value that's accumulated in that capital pot, that banking policy. Now, that's also backed up by 3.5 million of death benefit. But that's a pot of money that you can spend tax-free through loan provisions. You can take it tax-free. You can take it tax-free through withdrawals up to the basis of the premiums that you've paid. But you can take all of that money tax-free through loan provisions over your lifetime as, say, supplemental retirement income. Now, to have a tax-free source of supplemental retirement income, I don't know what you'd have to have in your IRA, and you don't know what you'd have to have in your IRA because no one knows what the tax rates will be in the future. But I would say with, say, $25 trillion in national debt and $100 trillion unfunded liability with Social Security, Medicare, that there's a chance that taxes are going to have to go up in the future. And you may be parking money into a government partnership plan at a lower tax rate than you would end up taking that money back out. And why would you do that if you have a vehicle here that you can accumulate and store up money, and you can have $2.5 million that you can spend tax-free? What if the tax rate at retirement goes to 50%? That's the equivalent of having $5 million stacked into your government partnership plan that's going to be taxable. But the great thing is that it subtracts that loan provision, that use of money over a lifetime. It subtracts that from the passable death benefit that's going to pass on tax-free to your heirs, minus the loan provision. But the other thing you look at is in that increase in net cash value per year, what's it doing? Well, you look at age 78 there, and this policy's got $141,822 of increase in cash value available for you tax-free in 1 year. Will that help supplement your retirement income? You carry on.
Absolutely. And, you know, when you say supplement, let's just say that somebody didn't have other income, right?
Yep.
They could use this completely.
They could use it completely.
In the case of let's just say they had socked away, money in their 401k.
Yep.
How much? So out of that 2.4 million of cash value, and as we've been discussing, the money could be just taken, surrendered. I don't know why you would want to do that, but if you use the banking process, you could actually use it during retirement for loans to actually borrow, and they would just subtract whatever you took from that death benefit, which is, as you see, continuing to grow over time, as well as the cash value. And at that point, look at that dividend. How much is that dividend? Look at that.
Yeah.
So in this case, you could take anywhere at a minimum, you could take 79,000 just in dividend. You could just take the dividend if you wanted, right? Yep. Or if you borrowed it, then this policy would produce somewhere in the neighborhood of about $140,000 per year, as John said, tax free, actually tax exempt, because it would be in the form of a loan, right?
Yep.
So it could certainly add to your retirement income, whether it be a supplement or entirely. Now, John, what would it take? I don't know if you can do the quick math, but what would it take to get $140,000 after tax out of a 401k or an IRA? How much would you have to have in there?
Well, after tax, it depends on the tax rate. That's an unknown.
Uncertain, right?
Yeah, that's an unknown. But before tax, it would, at a safe withdrawal rate, according to PhD in economics, Dr. Wade Pfau, at a safe withdrawal rate, it would take 5,076,000 before tax to get 141,822. And so if you went out of a government partnership plan and then you were taxed at, say, a 50% tax rate, you, in a safe withdrawal rate environment, you may need almost $10 million stored away to have that kind of generated income that was secure and stable in a withdrawal rate environment for a long period of time.
Unreal. So basically you'd have to have double the money to get the same amount of income.
Yeah.
So it's incredible what these policies can do over time. So moving on along, I just want to circle back to this process and how infinite banking actually works. It is a process. It's not about the product of life insurance. People get so caught up because they've been told to hate life insurance, just like they've been told to hate our president, right? Most people don't even understand why they hate him. They just know that the news and the media have told us that he's a bad orange man, right? And we should hate him. So they do the same because certain radio entertainers have told us to hate life insurance. But if you talk to somebody who actually owns life insurance, you know, and that's what I usually do. We talked in an earlier show about go to the source. Well, talk to somebody who's owned some life insurance for 10 years or more. Chances are they're going to love it, especially if you talk to somebody that has practiced infinite banking. So it is a process. It's not a product. It's just about owning the process. And we can do this through this wonderful creation and because of Nelson's work in creating the infinite banking concept. So, John, why would somebody want to practice infinite banking? Why would they want to do that?
Well, the first thing is to take back more control over their money, to gain some significant advantages by doing that with regard to taxes, allowing them to store money in a place that will grow their money tax-free, allowing them to have access to money throughout their lifetime, non-age restricted, tax-free through loan provisions, allowing them a tax-free source of retirement income distribution that's stable and secure, and multiplying the value of what they accumulate in their life so that they actually pass on a whole lot more than they accumulated, multiplied value 3-4 times as much as they accumulated to their beneficiaries at their passing. None of us know when we're going to pass, but we all know that we are going to pass, right? And so why not store up and get more control, unhooking from the banking cartel downtown? You know, have you noticed that the biggest buildings in every city in the country are the bank buildings?
Isn't that something?
Wouldn't you rather be in charge of the banking process and function in your life? Build that wealth into your family's legacy instead of the guys downtown that you don't know.
Exactly. So life insurance is really the cornerstone of the plan. And, but there's a dirty little secret. What is the secret, we just talked about why people hate life insurance, but tell people, John, who owns more life insurance? Who owns the most?
Well, the bankers own tremendous amounts of life insurance. And in fact, it's on their ledger, their balance sheet, as amongst their tier one assets. Their most stable and secure assets on their balance sheet is the value that's held in life insurance contracts, often insuring their executives and their employees. Corporations own a lot of life insurance. There have been some tremendously successful corporations that utilize this concept of borrowing, collateralized by their life insurance contract, borrowing from their life insurance contract to fund the capital investment of starting or keeping their business operations in operation and or funding the start. Walt Disney, J.C. Penney, McDonald's Corporation, Pampered Chef, right? And then you look at these banks down at the bottom, those banks all have massive amounts of life insurance on their balance ledger sheet. That's some of their most secure assets. Now, why would they do that and use that as their most secure assets, but they would try to tell you not to, but to give them control of your money?
Absolutely. Absolutely. That's what they want us to do, is put our money with them. So they own it, they control it. And unfortunately, many people do that. So we advocate infinite banking as a solution. And what it actually does is just have your money to work harder. You can take the same dollar and get multiple uses of your money. The first thing, obviously, with life insurance is it's going to protect your family and your business in the event that you're not there. So you've got protection. And it doesn't, we didn't even mention it here, but in most states, it's creditor protected as well. And of course, you've seen and heard of all of the attorneys and the lawsuits. And so it is creditor protected in most states. It also can be used to finance your purchases, which is what we're trying to illustrate to you here. So you get that financing ability. So your dollar is now worked 2 times. It's also growing your wealth because that nest egg that you're saving into is accumulating over time. And then when you're gone, that death benefit will help to secure your legacy for the future. So long after you're gone, this money that you've worked so hard for your entire life can now be used for your legacy, to give to charity, to give to your church, whatever your causes may be, and of course, your family. So infinite banking is the solution that we see with this. And if you have problems with debt, or maybe you just want to have your money work harder, well, then you might want to learn more about infinite banking. And of course, what we recommend is that you read this book. So find this book, Becoming Your Own Banker by R. Nelson Nash. And we hope you enjoyed this video today. Watch for more of our videos and share them with your friends and family. They need to know and learn this information as well. We hope you'll like and follow us on social media. And when you're looking for somebody, John, tell them a little bit about this Infinite Banking Concepts Authorized Practitioner Program.
I always say go back to the source, go to the source. And Barry and I are very strong believers and passionate about going to the source of information and truth. And so that's why we participate with the Infinite Banking Authorized Practitioner Program. That's through the Nelson Nash Institute. And that was pioneered by Nelson Nash. And to carry on his legacy, it's very important that you work with an authorized practitioner of the infinite banking concept, because those are people who not only were trained on how to build an IBC policy correctly, utilizing the right products, building it the right way with the right engineering and writers, but they also have taken an oath as a practitioner to make sure that if you're looking for an IBC product, that is what they're going to sell you. There are a lot of people out there that, oh yeah, we can do that. We can do that. And I've seen the train wrecks from those people who've gone to their friend who said, oh, I sell life insurance. I'll do that. And then the clients come back to me and they go, well, I got this IBC policy from my friend at Joe's, smorgasbord insurance company. And they said that they could do exactly what the book said. And why isn't it working right?
Yeah.
We go, well, because the guy didn't have a clue what he's doing.
Right. And so practitioners actually have to take tests, continue at education, and we have to adhere to the rules, meaning that we've owned these types of policies ourselves, right?
Yep.
I myself own multiple IBC policies in the neighborhood of 8, 9 policies now, and we accumulate them over time. So it doesn't happen overnight. But why do you think, John, that there aren't more IBC practitioners out there? It's kind of like, why do you think the banks say one thing and do another? Why do you think that there's people, like you said, that say they're doing IBC? We call them imposters, but they're not. Why don't they go through the program, do you think?
Well, some of it is just ignorance, lack of knowledge.
Whew.
And there are a lot of talking heads out there that are ignorant and they have lack of knowledge, right?
Mm-hmm.
And they'll say things and sound like they have authority or knowledge, but they don't. Then there are some in the financial industry that are paid to say what they say.
Yeah.
They may be paid by advertisers.
Yes.
Buy this product because we're paid if you buy this product, right?
Right.
They're puppets. And
right.
And then there are those that simply are heavily money motivated. And if they were to sell you a IBC product actually built right, if they knew how to do that, it would pay them maybe 30% of what they would get paid if they sold you this other product that they can sell you. Right. Now, they just don't want to take a haircut and get the loss of 70% of what they want to sell you, right?
Absolutely.
So they just simply won't set it up and build it right because it would cost them money to do that.
Yeah.
So those are the three main things that I see out there, I would say, and you may have some others that, are.
Well, I guess the only thing I would add to that is, it costs money to go through the practitioner program. It's not free.
Yeah.
And like you said, we give up commissions. Some of these naysayers out there like to talk about the big commissions we earn, but we actually earn less because we follow this IBC process. And, it's really just about giving back. We want to share this message just as Nelson did with as many people as we want. And, that's what we want to carry on, his legacy with Infinite Banking. And for those of you who want to learn more about starting your own bank, it's really simple. You just need to take action. There'll be links in the show notes. So please reach out to us if you want to schedule a meeting. And then, as John noted earlier, the first step is really, you just got to capitalize your system. As I showed you earlier, there is a capitalization phase, and then you have to practice this. It doesn't happen overnight, doesn't happen in 1 year. It takes time. But the longer you do it, the better it gets. There's nothing you can really do about it. It's hard to really mess it up if it's built correctly from the beginning. So we'll work with you with that. So if you want to get started, just reach out to us and schedule a meeting. And I just want to thank you for joining us today. John, is there anything else you want to add?
Thanks for being here. Get your questions answered. I've never seen a question that concerned me, scared me. And, when you deal in the truth, it's pretty easy to just share the information, share the truth, and shed light on what's going on.
That's right. The truth shall set you free, right?
Yeah.
All right. Well, thanks for joining us. We'll see you next time. Be sure to subscribe, hit the little button so you'll be notified of our new videos. And I look forward to talking to you in the next edition of Legacy Money. Take care.